Hey everyone, welcome to today's tutorial. We're going over the second capital structure tutorial, the chapter 15 one. So let's get straight into it. So chapter 15, how taxes affect dividends and share repurchases. So 15.1 is a theory question, so I'm going to let you guys go over that. 15.2. Let's go over this one. So you are considering buying shares in AMIC PLC, which is trading today at £12.31 a share. AMIC is going ex-dividends tomorrow, paying out £2 per share. If you believe the equity will drop to £11 following the dividends, should you buy the equity before or after the dividend payment? Explain how your answer depends on the tax rate on ordinary income, capital gains, and your expected holding period. So the answer, basically what you have to do is you have to compare scenarios. What you're basically doing is you're looking at, what scenario will give you the biggest bang for your buck. And to do this, you basically consider the costs, and the costs in this case would be the taxes that you have to pay. So whichever scenario gives you as the investor the lowest tax rate, that's the one which you'd go for. So assume that you have no capital gain tax, then the tax rate on dividends, TE, that'll make you indifferent between buying the stock before or after the dividend payment is this. So this is the equation which we're working with, 12.31 minus your £2 dividends times by 1 minus the tax rate on that dividends. It should equal 11, which is what we expect the price to be. So just solving this, changing the subject of formula and solving for TE, we'll get a tax rate of 34.5%. So thus, if your marginal tax rate is greater than, I think this was a typo, so instead of 25%, it should be the 34.5%, which is what we've calculated. So we'll say thus, if your marginal tax rate is greater than 34.5%, then you prefer to buy the stock after the dividend payment. So if your tax rate, your TE, is less than 34.5%, you prefer to buy the stock before the dividend payment. Now, if there's also capital gains tax, the answer depends on how long you intend to hold the stock. If the capital gains tax is high and your investment horizon is short, then you might prefer to buy the stock before the dividend payment. So again, just think about how these different taxes affect your investments, buying stocks and all of that. 15.4, again, it's a theory question, so I'll let you go over that one. 15.5, so pay attention to this one. It does get a bit confusing, but once you understand it, it will definitely make sense. So Hunter Industries has generated £1 million in excess of its investment needs. The firm can invest the excess cash in treasury bonds at 8%, or they can distribute the cash to shareholders as a dividend. So assume that the corporate tax rate is 28% and that the firm is owned by 3 different kinds of taxpayers. The first type is tax exempt. The second type has a 25% marginal tax rate, and the third type has a 40% marginal tax rate. Describe the decision preferred by the 3 investors, indicating the reason for the decision and providing calculations to show your conclusions. Next, consider the possibility that the firm can invest in preferred equity that pays 7% per year. Describe how this would affect Hunter's decision given the 70% dividend exclusion for corporate investors. So let's go over this one. From equation 15.4, investors prefer retained earnings to cash dividends if 1 minus the tax rate times your pre-tax return that you get from inside the corporation, so within the corporation, is greater than 1 minus the tax on dividends times the pre-tax return outside the corporation. So basically what return you receive doing whatever you're doing outside the business, outside the company. So that equation is very important. Remember it, especially for this answer. So we'll start off with the first type of investor, which is tax exempt. So for the tax exempt investors, we've got 1 minus the tax rate of 28% times our return within the corporation. Remember, we said that the firm can either invest this excess cash in treasury bonds at 8%. Okay, so they'll receive a return of 8%. So for the tax exempt investors, on the other side of this inequality, they don't pay taxes on dividends, so it'll be 1 minus 0. And the pre-tax return outside the corporation, it'll be 8% again, which is what this question assumes. So the tax investors, in this case, they would prefer dividends based on this inequality. And then for the investors with the 25% marginal tax, again, the left-hand side of the inequality remains the same, so it'll be 1 minus the corporation tax rate of 28% times 8%, which is less than 1 minus the 25%, which is what they pay on tax, times the 8%. So from this inequality, these investors prefer a dividend. And then for the third group of investors that pay a 40% marginal tax rate, we've got our 1 minus 28% times our 8%. So in this case, the left-hand side of this inequality has remained the same in all three scenarios. The only thing that's changing is the right-hand side of the inequality. So, which is obviously based on the tax rates. So so the right-hand side of the final one, 1 minus 40% times 8%. So in this case, the investors prefer treasury bonds. So yeah, just remember this equation, and you'll be okay. Know how to interpret the inequality, and that'll basically give you your answer for each of the scenarios. So for the final group of investors, they prefer treasury bonds, but the first two investors preferred dividends. Okay, now consider the following case. The firm can invest in preferred stock yielding 7%, and only 30% of the dividends received are taxed. One can show that in this case, only the tax exempt investors prefer dividends. So this part here is very important. The firm can invest in preferred stock yielding 7%. Of that 7%, only 30% of the dividends received are taxed. So we can draw up a table and make it look very nice. We've got three scenarios based on the different tax rates that the investors are charged. So we've got the 0%, the 25%, and the 40% tax brackets. And then the first is the treasury. So everyone would receive the same in this case, the 1 minus the tax rate, the corporation tax rate, times the 8%. That's what everyone will receive, 5.76%. And then for the dividends, we have for the first 0% tax, it'll be 1 minus 0% times 8%, which is how we get the 8%. For tax rate 2, it'll be 1 minus 25% times the 8%, which gives us 6%. And then for tax rate 3, it's 1 minus 40% times 8%, gives us the 4.8%. Okay, and then the preferred stock, which is the one that's a bit tricky. So remember we said that of that 7% yield which they receive, only 30% of the dividends received are taxed. So 30% of the 7% is taxed at 0% for the first tax rate 1, and then the remaining 30%, so 1 minus 30% times 7, is not taxed. So that's how we get the 7%. 30% times 7%, that's taxed at 0%, plus the remaining 30% times 7%, that is not taxed. Okay, so we'll do the same for tax rate 2. 30% times 7% is taxed at 1 minus, is taxed at 25%, so you'll say 30% times 7% times 1 minus 25%, plus 1 minus 30% times 7%. That the second part is the amount which isn't taxed. Add those two together and we'll get 0.06475. And then for the third tax rate, it'll be your 30% times 7% times 1 minus 40%. So that's the amount which is taxed, plus the 1 minus 30% times 7%, that's the amount that isn't taxed. Add it together and that's how you get this figure here. So that was that question. Just pay attention, go over it if it didn't make sense, keep reading the answer, and it'll make sense as you go over it if it was confusing. So don't worry. Next, 15.6. Again, this is a theory question. You can go over it by yourself. And then the last one, 15.8, it's a quick one. Alpha Corporation, they earned £150 million in before tax profits in 2011. Its corporate tax rate is 28%. Con Daniels, who owns 20% of the firm's shares, has a personal marginal tax rate of 22.5% on dividend income. From Daniels' perspective, what is the effective tax rate on Alpha's profits if its entire after-tax profits are distributed as a dividend? So remember, first the company pays tax on its profits, and from what remains, they're going to distribute that as dividends. And then this person, Daniels, his name is Daniel. From his perspective, he's going to pay, from what he receives as dividends, he's going to pay tax on that. So that's what it means by effective tax rate. What is the overall tax rate that he would pay? So it'll be your corporate tax rate plus 1 minus the corporate tax rate. That's basically what remains after taxes was paid. And on that, he'll pay his marginal tax rate, his personal tax rate, TE. And you basically plug in the numbers and solve that, and that's basically, that'll give you his effective tax rate of 44.2%. So remember, the profits from the company get taxed at TC. 1 minus TC is what will be distributed to Daniels. From that 1 minus TC, he then pays TE, and that's basically it. Yeah, thanks for listening, and I hope it helped.